Aradel Holdings has just released one of the most spectacular financial reports we've seen this year. Revenue didn't just grow, it exploded, up by 577% in just 6 months. Gross profit increased by more than 780%. Operating profit grew almost 790%. On the surface, this looks like the kind of report that makes investors rush to buy the stock. But buried inside these results is a number that completely changes the story. Despite all that explosive growth, the profit that actually belonged to Aradel shareholders increased by only 6.3%. So what happened? Did something go wrong? Or is there another explanation hidden inside these financial statements? Today, we're going to investigate exactly what happened, and more importantly, whether Aradel still deserves an investor's capital. Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required. Today, we're looking at Aradel Holdings PLC's unaudited half-year 2026 results. The shares currently trade at around 1,526 Naira 80 Kobo. These results matter because they represent the company's first major reporting period after a transformational acquisition that dramatically changed the size of the business. The question today isn't whether Aradel became bigger. The financial statements already answer that. The real question is whether becoming bigger has actually created more value for ordinary shareholders. Let's investigate. Before we examine the numbers, we need one crucial piece of context, because almost every dramatic change in this report can be traced back to a single event. At the end of 2025, Aradel increased its ownership in ND Western Limited, turning it from an associate into a fully consolidated subsidiary. Here's the simplest way to think about it. Imagine you own part of a friend's business. You record your share of the profit, but none of its sales, expenses, assets, or debts appear on your own books. Once Aradel took control of ND Western, that changed. Instead of recording only its share of the profits, Aradel now reports all of ND Western's revenue, costs, assets, and liabilities, even though other investors still own part of the business. ND Western wasn't the only addition. Aradel also completed a major business combination involving Renaissance Africa Energy Holding Company, in which it owns a 53.3% stake. That transaction is widely linked to the acquisition of Shell's Nigerian onshore assets. Why does all this matter? Because this isn't simply a story of Aradel producing more oil or becoming dramatically more efficient. It's the story of a company that became much larger, almost overnight. That single change explains much of what we're about to see: surging revenue, higher finance costs, larger decommissioning obligations, acquisition-related liabilities, and the disappearance of share of associate profit from the income statement. It also explains why not all of the reported profit belongs to Aradel shareholders. Other investors still own part of these newly consolidated businesses, so a meaningful share of the earnings will always be allocated to them. So as we work through these results, keep one question in mind. When you see revenue soaring or profits jumping, ask yourself, did the business actually perform better, or is it simply reporting a much larger business? One final point before we move on. Even after these acquisitions, Aradel remains overwhelmingly a crude oil producer. About 76% of revenue comes from crude oil, with gas contributing about 20% and refined products making up the balance. That means the company's fortunes will continue to depend largely on oil prices and production volumes. With that context in place, we can finally investigate what these numbers are really telling us. And the first clue is impossible to ignore. Revenue didn't just grow, it exploded. From 368 billion Naira to almost 2.5 trillion Naira in just 6 months. Gross profit jumped from 163 billion Naira to 1.44 trillion Naira. Operating profit climbed from 119 billion Naira to more than 1.05 trillion Naira. Those are extraordinary increases. But remember the context. Aradel hasn't suddenly become 6 times better at producing oil. It has become much larger because 2 major businesses are now included in its financial statements. That's the first part of the story. The second part is even more encouraging. Margins improved. Gross margin increased from about 44% to 58%, while operating margin rose from just over 32% to more than 42%. Why does that matter? Because if the newly acquired businesses were weaker, we'd expect margins to fall. Instead, they expanded. That tells us these acquisitions added more than size. They also improved the quality of the operating business. So based purely on operations, Aradel appears to be a stronger company than it was a year ago. But that's only half the investigation, because shareholders don't own operating profit. They own what's left after everyone else has taken their share. So where did all that money go? The first place is interest. Finance costs jumped from just over 11 billion naira to more than 326 billion naira, largely because the newly consolidated businesses brought significant borrowings with them. That explains part of the gap, but not all of it. The second place is tax. Aradel paid about 562 billion naira in tax, leaving it with an effective tax rate of almost 75%. That sounds extraordinary. For most businesses, it would be, but these legacy joint venture oil assets are taxed under Nigeria's petroleum profits tax regime, where tax rates can reach 65 to 85%. In other words, this isn't a temporary issue. It's part of owning these particular assets. Even then, the numbers still don't fully add up. Which brings us to the final place, minority shareholders. When Aradel reports the results of ND Western and the Renaissance-related businesses, it reports 100% of their profits. But it doesn't own 100% of those businesses. Part of those earnings legally belongs to other investors. And that's where the mystery is finally solved. Total profit increased by more than 30%. But the profit attributable to Aradel shareholders rose from 144.5 billion naira to just 153.7 billion naira. That's only 6.3% growth. The operating improvements were real. But before those profits reached shareholders, they passed through three filters: lenders, the tax authorities, and minority investors. By the time each had taken its share, only a small fraction of the improvement remained. The profits didn't disappear. They simply had far more people claiming them. So far, we've established that Aradel's profit is real. The next question is whether it became real cash. At first glance, the answer is an emphatic yes. Operating cash flow surged from 140.8 billion naira to almost 976 billion naira, more than 5 times the company's reported profit. Normally, that's a hallmark of high-quality earnings. It suggests the profits aren't just accounting entries, they're reaching the bank account. But the cash flow statement adds an important qualification. A large part of this increase came from higher trade payables. In simple terms, Aradel hadn't yet paid many of its bills, leaving more cash temporarily on hand. The newly acquired businesses also brought much higher depreciation charges. Since depreciation reduces profit without using cash, it's added back when calculating operating cash flow. Neither adjustment is unusual, but together they make this period's cash generation look stronger than the underlying business alone might suggest. That doesn't mean the cash flow is overstated. It simply means investors shouldn't assume this level of cash generation will automatically repeat. As those outstanding obligations are settled, part of today's cash advantage is likely to unwind. There is, however, one clear positive. Cash on the balance sheet increased substantially, helped partly by these timing effects and partly by bringing the cash balances of ND Western and the Renaissance-related businesses onto Aradel's books. So, can we trust the earnings? Yes, but with one important caveat. The business is clearly generating significant cash, but this period's exceptional cash conversion shouldn't yet be treated as the new normal. The next few reporting periods will show how much of it is sustainable. We are now at the point where the investigation becomes personal. The business may have become much bigger, but did each shareholder actually benefit? The first clue is earnings per share, or EPS, the portion of the company's profit that belongs to each share. EPS increased from 33 naira 26 kobo to 35 naira 37 kobo. That's a modest improvement, and it mirrors the small increase in profit attributable to shareholders. In other words, while Aradel expanded dramatically, the gain reaching each shareholder was relatively limited. There's one important positive, though. Management achieved that growth without issuing a single new share. The share count remained unchanged at about 4.34 billion shares, so existing investors weren't diluted. Book value tells much the same story. Book value per share edged up from about 343 naira to about 347 naira. Positive, yes, but hardly transformational. Aradel has become a much larger business, but the value flowing through to each shareholder has increased only modestly. One final point deserves watching. Although half-year EPS improved, second quarter EPS fell from 25 naira 49 kobo to 20 naira 13 kobo. One quarter doesn't establish a trend, especially in the oil and gas industry. But with the business still settling after two major acquisitions, it's a number investors should keep an eye on over the next few reporting periods. Shareholder returns are only part of the story. We also need to ask how management is handling a business that's now far larger and more complex. The balance sheet offers the first clue. Total assets increased from about 9.9 trillion naira to 10.9 trillion naira, while liabilities also grew, as you'd expect after consolidating two major businesses. The more revealing number is debt. Despite the larger group, total borrowings actually fell from about 2 trillion naira at year-end to 1.81 trillion naira at the end of the first half. That's an encouraging sign. Management didn't just acquire new assets, they also reduced debt while integrating them. Combined with the much stronger cash position we discussed earlier, it suggests management is paying attention to the balance sheet, not just chasing growth. There are still a few areas investors should watch. The headline current ratio sits at 0.81 times, which normally suggests short-term liabilities exceed short-term assets. But much of that comes from about 1.47 trillion naira of acquisition-related contingent consideration, part of the purchase price for the newly acquired businesses, rather than ordinary operating debt. Adjusting for that lifts the current ratio to about 1.1 times, giving a more comfortable picture of liquidity. Another figure initially looks puzzling. The company earned about 191 billion naira in profit, yet shareholders' equity barely increased. Most of the difference came from a 144 billion naira foreign currency translation loss, together with dividends paid to minority shareholders. So the profits were real. They simply didn't all flow into book value. The enlarged balance sheet also brings larger long-term obligations. Decommissioning liabilities now stand at about 1.37 trillion naira, while deferred tax assets total roughly 1.05 trillion naira. Both are typical of mature upstream oil assets and reflect the long-term responsibilities that come with them. One disclosure, however, deserves to stay on investors' watch lists. The company has disclosed about 727 billion naira of contingent legal claims relating to the Ogbele oil field. Management believes, based on legal advice, that no material loss is likely, so no provision has been recognized. That may well prove correct, but the amount is still large enough to monitor. Finally, it's worth remembering that the accounting for both acquisitions remains provisional. Some figures, particularly around goodwill and acquisition liabilities, may still change as the purchase price allocation is finalized. So how has management performed? The evidence so far is encouraging. They've integrated two transformational acquisitions without diluting shareholders, reduced borrowings, and maintained a sound underlying liquidity position. The next test is whether this much larger business can consistently deliver stronger returns for shareholders. All right, we've investigated the business. We've followed the money. Now only one question remains. Is the stock worth the price? At today's share price of 1,526 naira 80 kobo, Aradel trades at about 4.4 times its book value. In other words, investors are paying more than 4 times the accounting value of the company's net assets. That isn't necessarily expensive for a high-quality business, but it does mean the market is already pricing in stronger shareholder returns. Earnings tell a similar story. Annualizing the first-half earnings per share gives an indicative price-to-earnings ratio of about 21.6 times. It's only a guide. The enlarged business is still settling after 2 major acquisitions, but it gives a reasonable picture of what investors are paying for today's earnings. That's where caution comes in. The market isn't valuing the company Aradel was, it's valuing the company investors expect it to become. Whether today's valuation proves justified depends on one thing. Can this much larger business convert more of its operating success into earnings that actually reach ordinary shareholders? That's why this isn't an obvious bargain. But it's not an obvious stock to avoid either. The hard part, building a much larger business, has already been done. The next challenge is proving that shareholders will receive a larger share of the rewards. So, where does that leave investors? The investigation points to 2 clear conclusions. First, Aradel is a much larger and operationally stronger business. The acquisitions improved margins, borrowings fell, cash increased, and shareholders weren't diluted. Second, much of that operating improvement is still being absorbed by finance costs, taxes, and minority interests before it reaches ordinary shareholders. That makes the next few reporting periods critical. Now the verdict. For existing shareholders, hold. The business is stronger than it was a year ago, but the full benefit of the acquisitions has yet to reach shareholders. Hold and watch whether earnings per share and cash generation improve as the enlarged group settles. For new investors, watch. Aradel has executed a transformational acquisition successfully, but this is still the first reporting period under the new structure. Waiting for another 1 or 2 results should provide a much clearer picture of the group's sustainable earnings power. If there's one thing to remember from today's analysis, it's this. Aradel has already succeeded in building a much larger company. The next challenge isn't getting bigger. It's making sure more of those profits eventually reach ordinary shareholders. That's the number investors should keep watching over the coming quarters. Before we wrap this up, remember, this video is not financial advice. It is for educational purposes only. Always do your own research or consult a licensed financial advisor before making investment decisions. Now I'd like to hear from you. At 1,526 Naira 80 Kobo, would you sell Aradel Holdings, hold what you already have, or wait for a better entry price? Let me know in the comments below. If you enjoy evidence-based investing without the hype, like this video and subscribe to Behind the Numbers TV. Also, turn on notifications so you never miss our next deep dive into the Nigerian stock market. Because every number tells a story, and together, we'll learn how to read it. See you in the next video. Thanks for watching.